Well, equities and currency markets are both riding the Modi wave to new highs, but how much more juice there is left in the rally is the question we are asking our market master today. Joining us now is S Naren, CIO Equities at ICICI Prudential AMC. Naren, good morning. Thank you very much for joining us. These are actually all historic days because every day is a new high for the Sensex, every day is a new high for the Nifty, and as we now understand, for the mid-caps as well, new highs are being notched up. What is the sense you're getting? Will this year, 2014 calendar year, end with much more highs, or have we pretty much sprinted most of the rally?
Actually, what we believe is on the economy side, we are going to see a drastic improvement over the next 3 years. Let's say an indicator like industrial production, I expect it to be in double digits in the next 3 years sometime. And you would like...
in the next 3 months, you said?
Growth across the 3 years, 3 years.
Right, sorry, okay.
So I'm saying when in the next 3 years, I don't know. But the fact is that every economic indicator, like it could be consumer price inflation, it could be industrial production growth, it could be GDP growth, all these indicators I think are going to drastically improve in the next 3 years. I think the government is going to focus on the economy, market is going to get the benefit of the economy improvement. So that obviously trickles to small caps, mid caps, banking, infrastructure, value. All these kind of areas are the ones which normally tend to benefit when you have an economy-based economy improvement. And that's what we expect to see. The beauty about stock markets is it can run far in advance of what happens to the economy, what happens to data, what happens to earnings. So that's the phase we are in at this point of time. But where I think compared to 1 month back and now where we are different at this point of time, we think that equities is a compounding story for quite some time. And because it is a compounding story, the risks have come down significantly. That does not mean the market can't have a dip due to El Nino or some other reason. And also because of the fact that, you know, market seems to think that the government will be focused on the markets. I seem to think that the government will be exclusively focused on the economy, and the focus on markets would mean faster returns from a market perspective, but whereas when you focus on the economy, the returns will come slowly over a period of time. So I think the outlook for the long term is significantly improved. If you look at it purely from a short-term point of view, you can have debates on whether you should wait for a correction to buy, etc. But when you're so sure of the long term, it looks like a good time to still add to equities because domestic investors are so underinvested at this point of time.
Okay, our head of markets desk, Anuj Singhal, is also joining us in and giving some relief to Sonia, who is not able to continue. Hi, Anuj, go ahead.
Hi, Naren, hi, morning. What about banks then? Because, you know, as I said, over the next 3 to 4 years, maybe we'll have, the economy coming back. But just for the next 1 year or so, from valuation point of view, do you think some of these stocks have run up too much and, would be a good case of profit booking, especially the PSU banks?
See, through last year, the same time, what we were trying to tell people is consumer is very overvalued, technology and pharma are also overvalued or richly valued. The point is it took 1 year for it to play out. Like that, people are expecting that, everything will happen in a very efficient market and everything will be rightly priced. What I have learned from my years of investing, there are times when the market will be irrationally underpriced. There will be times when markets will be irrationally overpriced. I think in all the cyclical sectors, we need to move from the reasonable fair valuation kind of framework that we have to overvaluation. And maybe in all those quality companies like FMCG, pharmaceuticals and technology, you will have undervaluation soon for the same reasons that we had overvaluation last year. So I think that's how things play out, and this is what we've seen over a period of time. We have always been troubled when one sector becomes very badly overvalued, like it happened in 2007 and 2013 same time. Now we are not in that phase. In fact, everything looks reasonably fairly valued. So I think some set of stocks in this will get very overvalued, and then we will again go back to the uncomfortable phase. But that looks to me 18 months away.
Okay, just to continue with that bank theme, Naren, what is fair value for PSU banks at least? Is it one-time book? I mean, if you want to speak a little bit about forward, yesterday we spoke with Arundhati Bhattacharya, among others, in one of the road ahead panels that we were speaking with. And her point was that NPL cycle doesn't turn around till 2 quarters after GDP turns around. If that is the case, then we still have a little bit of bad news left in these stocks. Is it profit-taking time, or is it still time to tank up on PSU stocks?
I think what will happen is there will be 2 or 3 units which are perceived as NPLs, which will raise equity money. And once they raise equity money, the NPL outlook for the banking system will drastically change. See, I am talking about double-digit industrial production growth over a 3-year period. So, just imagine when you have double-digit industrial production growth, this worry on NPLs, how low it will be at that point of time. So I think clearly whether markets can go through a volatile phase because of returns in equity markets coming much before the economy improves, yes, very much possible. Does the verdict suggest that on a 3-year basis the economy will improve significantly? The answer is yes. So I think we should be prepared for periods of volatility, but those periods of volatility I won't worry about because the medium-term outlook is very, very good.
Naren, last year we had the problem of currency depreciation. That was a big risk for the market. Do you think this year currency appreciation could be a big risk as we move forward?
See, currency depreciation is a much bigger risk than currency appreciation. Currency appreciation risk can be taken care of by RBI buying significantly dollars. And I think that might happen. And if you see the way they did the FCNR event, they effectively became short dollars, $34 billion. So they have a beautiful opportunity to cover that $34 billion. So I don't think currency appreciation can be such a problem as what currency depreciation was last year. Having said that, I think it is important for India to become an export hub. So I hope we don't have too much of appreciation, because if we have too much of appreciation and the possibility of being an export hub goes away, I think clearly we are in a different situation. But the irony at this point of time is not in equity markets. In my opinion, the irony is still in fixed income markets, where such a big currency move reduces inflation. Such a big solid amount of money which has come into the markets means that liquidity has to become easier. Other than the risk of El Nino, if you take an 18-month phase, you are betting on inflation improving, and if inflation improves, clearly you are expecting interest rates to go up. The fixed income market is in some other world at this point of time. So I would say there, barring the El Nino risk, the market is so attractively valued and people are not willing to look at, whereas they want to hide in low duration assets at this point of time, which I'm not able to understand at this point of time why they should do it.
Well, Naren, I guess the market is a little worried that